Welcome to the final episode of our management control series here on ActioFin. For decades, control meant financial control. That has changed. Investors, regulators, and customers now demand hard numbers on environmental and social performance, audited to the same standard as the accounts. In Europe, the CSRD directive makes much of this mandatory. This episode shows how the controller's toolkit extends to steering sustainability, not just reporting it. Our plan, why ESG has become a management control problem, not just a communications one. What the CSRD directive actually requires. The principle of double materiality at its heart. The 3 scopes of carbon emissions you must measure. A worked example with a food producer. And the closing takeaways for the whole series. Why is this suddenly a controller's job? Because the rules changed what ESG is. It used to be a glossy brochure written by the communications team. Under CSRD it becomes assured, audited data with legal weight. The moment a number is measured, targeted, and audited, it needs the discipline you have learned across this series. The plan, measure, compare, act loop, clear ownership, and variance analysis. Sustainability has become, quite literally, a control problem, and finance is the function that knows how to run one. A brief word on the regulation itself. The Corporate Sustainability Reporting Directive, CSRD, is the European Union's framework for non-financial reporting. It requires companies to report against a common set of standards, the ESRS, so results are comparable. It demands external assurance, meaning an auditor checks the numbers. And it integrates sustainability reporting with the annual financial filing rather than leaving it as a side document. Standardized, assured, integrated, 3 words that turn marketing claims into accountable data. At the heart of CSRD sits double materiality, and it is worth understanding precisely. You must report in 2 directions. First, financial materiality. How do sustainability issues, like a carbon price or drought, affect the company's finances? Second, impact materiality. How does the company affect the world, its emissions, its treatment of workers, its effect on communities? Traditional risk thinking covers only the first. Double materiality forces the second onto the management agenda, with measurable targets attached. Double materiality sounds abstract, so here is how it works in practice. You list the sustainability topics that could touch your business: climate, water, labor, data ethics. For each, you score 2 things: how much it could affect your finances, and how much your business affects the world through it. You consult stakeholders, employees, customers, investors, communities, to challenge your scoring. Topics that cross a threshold on either axis are material and must be reported in depth. It is a structured, documented judgment, not a vibe. And the documentation matters because the auditor will ask how you decided what to leave out. The assessment is the foundation the whole report stands on. The most asked sustainability number is carbon, measured in 3 scopes. Scope 1 is direct emissions from sources you own, like company vehicles and on-site boilers. Scope 2 is indirect emissions from the energy you buy, mainly purchased electricity and heat. Scope 3 is everything else in your value chain, both upstream suppliers and downstream product use. Scope 3 is usually the largest and the hardest to measure because it lives outside your walls. Which is exactly why it needs a controller's data discipline. It is easy to reduce ESG to carbon. But the S and the G matter just as much, and CSRD covers them. On the social side, you measure things like workforce turnover, gender pay gap, health and safety incidents, and conditions deep in your supply chain. On governance, you report board composition, business ethics, and anti-corruption controls. The discipline is identical to the environmental side: define the metric, set a target, assign an owner, and review the variance. A controller who can already run financial control is well placed to bring that same structure to social and governance data, which too often lives in scattered spreadsheets owned by no one. Here is where most sustainability programs actually struggle, and where finance adds the most value: the data plumbing. Audit-grade ESG numbers need the same controls as the general ledger: defined sources, clear ownership, version control, and a trail an auditor can follow from claim back to evidence. Most companies have strong ambitions and weak data lineage. Their carbon number lives in someone's spreadsheet with no documented method. The controller's instinct for reliable, traceable, controlled data is exactly what turns a well-meaning estimate into an assured figure. In sustainability reporting, the bottleneck is rarely willingness, it is data you can stand behind. Consider Brindle Foods. It had spent years cutting factory energy use and proudly reported a 30% drop in its direct Scope 1 and 2 emissions. Genuine progress. Then CSRD forced it to measure Scope 3. The result was sobering: emissions from farming its ingredients and from packaging were about 8 times its entire direct footprint. All that effort had been aimed at the small part of the problem. The data redirected the whole strategy toward suppliers and packaging. Treating it as a control problem, Brindle put for sustainability KPIs on the board dashboard, each with a named owner, exactly as it would for financial targets. It set reduction targets, ran quarterly variance analysis against them, and worked with farmers on lower impact methods. In the first year, supply chain emissions fell 18%, and the figures passed external assurance. Sustainability stopped being a report written after the fact and became something the company actively steered, which is the whole point. 3 mistakes. First, ignoring Scope 3 because it is hard, which misses most of the footprint and most of the savings, as Brindle found. Second, treating CSRD as a disclosure exercise, publishing numbers with no targets. Owners or variance analysis is compliance theatre, not control. Third, underestimating greenwashing risk, now that claims are assured and integrated with the accounts. An unsupported boast is an audit and legal exposure. Every sustainability number must be as defensible as a financial one. A quick look at how a carbon figure is actually built, because it demystifies the work. You almost never measure carbon dioxide directly. Instead, you collect activity data: liters of diesel burned, kilowatt-hours of electricity, kilos of beef purchased, and multiply each by a published emission factor that converts it into carbon. Sum it all up and you have your footprint. The hard part is not the multiplication, it is gathering reliable activity data from every corner of the business and the supply chain, and being able to show where each figure came from. That is pure controllership: definitions, sources, evidence, trail, which is exactly why finance owns this. Let us end the case with why this is more than a compliance chore. Controlled sustainability creates hard financial value. Cutting energy and waste lowers cost directly. A credible ESG record increasingly lowers the cost of capital, as lenders and investors price climate risk, and it wins tenders where buyers now demand supplier data. Conversely, a greenwashing scandal destroys value overnight. So when you bring management control discipline to sustainability, targets, owners, variance analysis, assured data, you are not just satisfying a directive. You are protecting margin, reducing risk, and opening markets. That is the business case that turns ESG from a cost center into a source of advantage. To close the series, ESG is no longer communications. Under CSRD it is measured, audited data that needs real control. Apply double materiality, looking both at how the world affects you and how you affect the world. Measure all 3 carbon scopes, especially the value chain. And above all, use the discipline from these 7 episodes: plan, measure, compare, act, to steer sustainability with the same rigor as profit. That is the modern management controller's job. That completes our management control series, from the controller's role, through costing, budgeting, variances, scorecards and rolling forecasts, to sustainability. Each topic has a full course, with calculators and practice cases, on ActioFin.com. Steer the business, financial and beyond. Until next time, from all of us at ActioFin.